But on a serious story today, which harkens back to leverage in hedge funds, and we're going to talk to her right now about risks and shadows and opaqueness that's out there from 2 years ago, or might I suggest July of 1998 as well. I'm going to go right to the top of your story. How leveraged is the leverage discussion of a bond transaction?
Listen, a lot of these trades are very significantly levered, sometimes 50 to 1 or more. And the reason this was always okay is because it's in the Treasury market. This is the most safe, liquid market in the world.
Until it moves.
Until it moves. And now it's moving quite violently, as we know. And so we know that ever since the LDI blow-ups that we saw earlier in the UK, banks have been asking hedge funds to cool it, essentially. They've been asking for more margin. They've been reducing risk. But listen, a lot of this leverage comes from repo markets, sometimes sponsored repo, which is money market funds. So there are a lot of worries here under the surface in Treasury markets.
Gensler wants clarity here. We got opacity in that. We understand we had a banking crisis because we really didn't know what was going on at SVB. Do we know what's his name? Griffin?
Ken.
You know, he's going to buy like the Miami Marlins and the rest of Florida as well. Yeah. Ken Griffin, do we know what he's doing? Do we know his 50 to 1 leverage on these transactions?
Listen, these are called basis trades. They're fairly simple trades that arbitrage the difference between Treasury futures and spot. Citadel, Millennium, Exodus Point, Capula, Alphadyne. These are some of the biggest players in this space. Our sources say that Citadel is not as levered to the trade as they have traditionally been in the past, or as peak leverage has kind of gone before. But we know, guys, not only has this caused major losses among hedge funds in the past, the reason it's a problem is it's caused the Fed to step in. People forget that in 2020 the Fed has had to step in on this trade. And
are they stepping in 2023? Do we know that within our reporting?
I think that's a lot of the problem here and why there's a worry here. There's a kind of implicit understanding in the market that the Fed does step in. They have to step in. The hiccups in the Treasury market are not of the making of the hedge funds this time. It's of Washington.
Yeah.
However, it's not clear that the Fed wants to bail out hedge funds again.
Just to be clear, why would the Fed have to step in? And why would that be called a bailout of hedge funds?
Well, it's interesting because in 2020, when the Fed stepped in, there was the pandemic going on. So it was more about the pandemic and less about the hedge funds. What's less explained is 2019, when they had to step into repo markets because of more drastic movements. And again, a lot of these hedge funds were levered towards the trade. This time around, if there were any major issues, you could say, well, we didn't cause the Treasury market volatility and we didn't cause the downgrade.
I want to make this clear. Are there major issues now, or are we reporting that there seem to be shadows from 2 years ago?
No, there are issues now. There are issues. The reason there are issues is not that these trades are blowing up right now or anything like that. It's the issue that what underpins these trades is repo leverage and this idea that if there were any potential downgrade in the Treasury, then all of the collateral underpinning these trades are not worth what they were yesterday. So there are real issues in the market that the debt ceiling does exacerbate to some degree. But again, these are highly levered trades and a lot of the leverage is bilateral. So it's very, very opaque. Guys, changes have been planned or talked about since the Obama administration. It's not really changed much at all. And when you see such violent moves in Treasury markets, that's when banks and regulators start to ask questions.
Is there a danger, though, that we're blaming hedge funds for something that is the responsibility of politicians in Washington and poor policymakers at the Federal Reserve?
It's not blame per se. This is kind of a market structure question. There have been a lot of calls in recent years to make this market more transparent, and it hasn't really gone that way. And so when we're thinking about what happens now and the potential risks, I think, even if you're all clear, we have to remember that this is a market with a history of blow-ups. This is a market that there have been asks for change. And, by the way, it could be forgotten about if they have a debt ceiling compromise here and some of these issues.
I get the rating decrease idea, even on a 50 to 1 leverage. And I have the clearest memories of learning how you get from 3 to 1 to 12 to 1 to 22 to 1, whatever it was with LTCM. But to John's key question here as well, what's the so what here if they're just hedge funds and if they lose money, why do I care?
If
Bobby Axelrod goes under, who cares?
Listen, you're making the hedge fund point, which is, hey, we don't see blow-ups.
I'm just trying to get on billions here. Play with me. We'll get on billions.
No. And
help me here. What's the so what here if the hedge funds get hammered on this?
Don't forget that the Fed has had to step in before. That is the problem. If there are moves that are already violent that are then exacerbated because you have a ton of leverage in a market as well, and that creates moves that are more violent in repo markets, which, by the way, matter to markets that are not just hedge funds, that's the worry here, right? Toying with a market that is supposed to be the underpinning of the entire capital market.
I mean, Sonali, as our chief Hamptons correspondent, I mean, seriously, she's the one with the most distance here. What's the distinction between a lobster roll in Southampton versus way out on Montauk?
Wow, there were a lot of restaurants recently purchased, weren't there? You're probably paying a lot more for them.
Big season, seriously, big season in the Hamptons for the hedge fund crew?
Yeah, I would say so. I mean, obviously they're trying to get out there, but remember, people expect deal activity to come back after kind of we have this debt ceiling issue resolved and after the Treasury general account build and all these arcane things that we're talking
that's
about.
The hope.
The debt ceiling
that's
issue.
The hope, but
listen, they're staffing up. Like if into the summer, staffing levels are going to stay high. People are worried about things like, guys, like there's so many risks under this market. That's what this story is telling you. And regulators and bankers are asking about it. So the idea of taking a whole lot of time to chill out this summer is not a popular idea.